stage, a lot of them being reported, and Mass Financials is one of them, which reported a decent set of Q2 numbers. Net interest margins came in healthy. AUM grew by 18% as well. The stock is up around 0.6%. At a point in time, it had spiked, and now seeing flattish numbers right now. Kamlesh Gandhi, who is the chairman and MD at Mass Financial Services, is joining us now to take a few questions and understand the outlook going forward. Mr. Gandhi, good afternoon. Thank you so much for joining in. Well, it's a good set that you have reported. You aim to grow AUM in the range of 20 to 25% going forward, which is currently the growth number is 18%. What makes you confident that you'll grow at 20 to 25% from the current 18 levels? What are the triggers here?
Very good afternoon. The growth in this quarter was in lines with our strategic intent, where we always prioritize profitability and risk management over just the numbers, the AUM growth, what I mean. And historically, if you see that we have demonstrated our capabilities over a very long period of time to grow anywhere between 20 to 25%. And we remain confident that in medium term, we'll be in a position to achieve that growth anywhere between 20 to 25%. On the back of improved eligible demand. Because when we talk about credit demand, we have to talk of eligible demand in the same vein. And we are seeing some improvement post the challenges, what we have been seeing since last almost 1.5 years, that the eligible demand is increasing, and hopefully from Q3 onwards, we will see a better Q&Q growth and gradually get into a trajectory of anywhere between 20 to 25% as we have demonstrated over all these years.
Okay, so if you want to narrow down the range, especially for FY26, would you be towards the lower or the upper end of the range? Also, Q2, like you've indicated, the number of eligible borrowers have increased, so you're expecting a pickup as far as Q3 is concerned. Could you quantify that? Can you see a pickup in the range of 5 to 6% over there as well? And what about asset quality, especially in the small and mid cap? The loans over there were pretty weak.
Yes. So if you see, we grew at 4% over Q1 as far as Q2 is concerned. And we see this growth going upwards to anywhere between, say, 5 to 7%. Once again, depending upon the market situation. But as it looks like right now, it looks very promising. And with this improving, we can see at least reaching at the lower end of our target at around 20 to 25%. And with quarter-on-quarter increase, say 5 to 6% this quarter, and then incrementally increasing the quarter thereon, should take us very nearer to what we anticipate to grow between 20 to 25%. Okay. And we being predominantly into MSME funding, right. We will see a better results once we find, as I shared with you earlier, once the eligible demand picks up.
So right now it saw single-digit growth, the MSME segment. What kind of growth will you look at? Will it be high double-digit, mid double-digit? What's the target here once you say the eligible demand improves?
It should be in mid double-digit, but all product combined. As you know that we are a diversified NBFC, and we serve various assets, including wheels and to an extent salaried personal loans also. So combination of all those things should give us the desired growth, and MSME should grow in a mid double digit.
In the second half itself?
I did during the second half, yeah.
Okay, Mr. Gandhi, in the quarter gone by, two highlights. Number one was the credit cost that declined on a sequential basis. What will be the credit cost guidance for the rest of FY26? And number two, what is the reason for such a high OPEX?
Starting from the credit cost, I think that varies from quarter to quarter depending upon our configuration of the off-book and on-book assets. We assign assets very regularly to the other financial institutions. So depending upon what we keep on book and what we assign, there will be a slight change in the credit cost from quarter to quarter. But if I give a guidance, overall, we maintain our guidance that our credit cost will remain anywhere between 1.35 to 1.5%. That is what we have historically maintained. And in terms of OPEX, we are increasing our distribution strength. We have added close to 500 employees this quarter in order to fuel our distribution strength. We currently work at 15,000 PIN codes. And once the disbursement picks up, the OPEX will also moderate. And secondly, we are moving more over towards our retail distribution. and that is the result why the OPEX cost looks higher. But overall, in terms of our ROA metrics, that has been offset by better yields, and that does not disturb our ROA metrics, and that is what the strategic intent is. That irrespective of whatever the operational cost is, it should commensurate with the yields that it can generate.
Okay. You did mention 3% ROA. That is the guidance that you have, or the targets that you have. Any timeline that you have in mind, not as guidance but as an aspiration? What are the levers for this particular growth that would come by, the number on ROA?
If you ask for aspiration, is right now. But it will take some time as we gain the critical mass, as we can control the operational cost, the credit cost, and more importantly, when we can get the real benefit of the rate transmission. While the repo rate has reduced over past 2 quarters, but the real transmission is yet to happen. So once the transmission happens, so the combination of all the critical mass, improvement in credit quality, improvement in efficiencies, and improvement in the borrowing cost, altogether should take us from current 2.85, 8.8, 2.85 to 2.87 to 3%. As you know that we don't have a very long margin to be covered, but even though it will take few quarters before we really reach there.
Okay, thank you so much, Mr. Gandhi. Thank you so much for joining us and explaining to us about how Q2 panned, and wish you all the best for the rest of FY26. Well, moving on, we'll now slip into a short break. More on the markets on the other side.